Hi, and welcome to this January's edition of Capital Market Review. This edition will talk about the year in review for 2022 and specifically the fourth quarter. 2022, at best, was difficult. We had a weak market that affected nearly every single asset category. In fact, the only place to hide seems to be cash. We had a war that started with Ukraine, aggressive monetary policy by the Fed, and let's just say it was a fairly difficult year. In addition, it made general investment themes also difficult. The much revered balanced portfolio, traditionally used for folks that are retired, widows, orphans, those folks who want some degree of capital growth, but some protection or blunting from downside risk, also felt pain. For the first time in over 40 years, a balanced account significantly underperformed, where returns last year were in the minus mid-teens, which is certainly something that you wouldn't expect from an account that's supposed to be conservative. As we every quarter come up with a theme that will reflect what is happening currently, we decided to use potentially more pain before the gain. We do the next year, or this year, I should say, 2023, to be somewhat pivotal. We expect that the worst may not yet be over, but we certainly have seeds of recovery that are beginning to be sown as well. So once we get through this rough patch, which is a realization that the economy is deteriorating and the impact it might have on earnings, that at that point, the market tends to recover and recover well ahead of the economy bottoming out. All of this we expect to see unfold in the months ensuing in 2023. As always, we do these capital market reviews because we believe that the economy matters. And in this program, we're going to dissect some of the key components to the economy. We will look at growth. We will look at employment. We'll look at profits and profit margins. Certainly, we will talk a bit about inflation and also Fed policy and interest rates. We do this in an attempt to answer two important questions: where we think we are now as it relates to the economic cycle and where we're heading. And in terms of managing money for our clients, a lot of our themes, our theses, are really based on answering two important questions. One, where exactly are we on this cycle? And what is the Fed up to? Or more importantly, what is the Fed most likely to do next? Our agenda for today is somewhat short. We will quickly review last year, both in terms of the economy as well as market performance. We will then focus on monetary policy and what we expect policy to look like for the balance of the year. And then we will also talk about what are the implications of investing across multiple asset classes. So let's get right into it and take a look at the market and economic performance. Forgive me, this slide is a little bit busy, but hopefully we can kind of walk through this a bit. This is often referred to as a Callan slide or a Callan table. There are many of these types of tables. This one in particular goes back to 2008. That was the financial crisis right up through this past year. And it talks about performance relative to certain asset categories. You will see those asset categories being reflected in multiple colored boxes, each box representing a different asset, and they're stacked ranked from best to worst. So if we go to the far right, third from the right is 2022, and you'll see commodities were actually the best performer. That was solely because of energy prices as they were rising. Those have since kind of fallen off a bit. Cash was king, being up about 1.5%. And then just about every other investment category was down mid-teens, mid-20s, or worse. It was a very difficult year. and quite problematic, as I said before, for a balanced account. The reason is a balanced account, being part equity, part fixed income, had no place to hide. The equity markets were down teens, 20, 30%, and the bond market was also down mid-teens. Any combination of both would effectively drive returns into solid negative areas. The one takeaway on this, as bad as it was last year, we can certainly see that if we were to look over a longer time frame, 3, 5 years as an example, returns generally for most would be quite positive, with even a balanced account being up over 30% over the course of the last 4 or 5 years. So portfolios are certainly higher in spite of the weakness that we've seen. The real question is, how much more weakness will we have before the bottom is actually put in? Talking about the market and talking about where we are today, we've got to look at certain components which will have somewhat of a negative effect on our economy. Economic growth is beginning to wane a bit. If you look at this chart, you'll see the light blue hash mark running in a 45-degree angle. That's the trend line, and that's 2% GDP growth per year on average, going all the way back the last 20 plus years. And then you'll see on rare occasion, the dark line is above trend, and then it to the mean, and then stays below the period for a long period of time as well. We'll see near the far right, a large drop, which was the COVID recession, and then a brilliant recovery off of that back to trend line. And now we're waning off of that a bit as well. So when we look at year over year economic growth, Q4 2021, just a year plus ago, we were looking at year over year growth of almost 6%, quarter over quarter of well over 7%. And now year over year growth is under 2, and it looks like it may get weaker from here. One of the reasons that we're not actually in a recession at this point is because of the strong labor market. The unemployment rate is quite low. When we look at the last 50 years, the unemployment rate is averaged closer to 6, which is trend line. We're at a 3 handle today. And when we look at the wage growth rate, that's about 4. Wage growth has actually been improving of late as we've been re-engaging the economy. But if you look to the far right again, you'll see where wage growth is beginning to slip off of the big recovery from the lows as a result of COVID. And the unemployment rate, while it bottomed out, is certainly not going lower. It's beginning to moderate, flatten, and slightly curve up. More than likely, we will see an increase in unemployment as we're beginning to see companies restrict hiring, and in some cases, just absolutely reducing headcount. We would expect to see more of that going forward. Another indication that the overall economy is beginning to weaken. Also, big difference this past year, 2022, compared to 21. We saw a huge shift in year over year operating earnings. Again, far right, you'll see second in from the right, 2021, where we had a 70% improvement in margins coming off of 2020, again, the COVID year. This year, 2022, we saw much, much less margin, actually a reduction of over 14%. And revenues increased by about 9. Now, again, the long-term average of revenue increase is more like 3.8. Margin increase about 5. So margins are off quite a bit and revenues were up. So what would explain that? One of the big reasons is this chart isn't inflation adjusted. Many companies reported an increase in revenue while they actually reported a reduction in units sold. A lot of that was adjustment in price as a result of inflation. And in many cases where prices went up but didn't cover input cost, margins shrunk. And we would expect to see more of that as the year unfolds. Looking at inflation, we're also seeing where that is somewhat moderated. If we look at the very top line, which is headline inflation, and again, this is a heat map. So think of it as green is good, red is bad. And if we look at those months covering 2022, you'll see to a large degree they were mostly red. And inflation peaked at something just a bit over 9% in terms of year over year. That number through November was 7.1. Currently, it's a bit more like 6.5 or so. Those numbers are beginning to come down. And you'll see in areas of energy and in some degree food, we're beginning to see some moderation. We're beginning to see those numbers as of November, again, far right hand side. You're beginning to see those numbers shifting to green or light green. The exception, though, is core services. And in that case, we're still solidly in the, that's a concern of the Fed, that a large component of the inflation that we see may be a bit stickier. Yeah, frankly, the concern is it may be a whole lot easier to get from 7% inflation to 4%, but it's going to be a lot more difficult to get from 4 to 3 and 3 to 2, which would indicate maybe higher rates for longer or just simply longer rates being high. Another thing to consider is the global economy. And we're also seeing some difficulty there. Again, another heat map. This one based on Purchase Managers Index. Green is good, red is bad. And you'll see 2020, which is about 2/3, 3/4 of the way across the top of the page, primarily red throughout. And then things began to turn green as we moved into early 2022. And then those colors started to weaken. We started seeing some autumn colors develop. And here we are, 2022, far right. December, November, those colors look a lot more red than green. Things are beginning to slow up, not only here in the US, but all across the world. Although you would see that in some places like the Eurozone, their fall back is less prevalent than the US. US in December, much more solidly red than other parts of the world, which gives the indication and cause for why many analysts believe that Europe may actually bypass a recession this year, whereas the US may very well have one. Whether it's severe or not remains to be seen, but even a shallow recession can have its impact on valuations, prices, and employment. Another thing that's happened last year, and it's beginning to reverse a little bit this year, is the strength of the US dollar. As of December of last year, the US dollar, and by the way, this is the chart to the left, the US dollar got to a point where it was as high as it's been since early 2000, the 22-year high. And that number's come off a bit. We certainly expect those numbers to continue to weaken here a bit as we move into this particular year, as the economy weakens here. Part of that strength came from the fact that the US acted more quickly and to a greater degree in terms of raising interest rates. But now you have the ECB and other nations beginning to raise their rates. So the US dollar is beginning to cool off a bit. In my opinion, that's a welcomed sign, because one of the issues with a high dollar is it has a horrible effect on the current trade or current account balance. That's the chart on the right, the upper chart. And you'll see where the number right now or through the end of the third quarter was a minus 3.4%. What that represents is the trade balance, what we owe other countries and what they owe us. High US dollar means international securities are cheap. We tend to buy more of their things than we export our things. And as a result, we owe them more dollars than they owe us. Right now, that balance is closer to 4%. And to put that in perspective, 4% of our GDP or 4% of our productive activity is going just to cover that effectively debt service. That's money that's not left to be reinvested to grow our economy. It becomes problematic. Let's shift focus for a second and see what the Fed's doing. And let's look at the difference between what the Fed has stated and where the market is. We've seen this chart a number of times before. We've been looking at this chart for a number of years now. And usually that third hump that you see ending with with interest rates dropping to essentially zero in and around 2020 was flat for quite a number of years. And then sometime last year, we started seeing that line starting to move horizontally in an upward direction, but in an ever so slight upward direction. The reality is we got 4.25% interest rate hikes in a very short period of time. You've never seen the chart increase by quite that amount as quickly. You also notice some dotted lines, which are projections. Let's look at the, I guess it's the blue set of lines, and that's the projection of the FOMC, or the Federal Open Market Committee, Federal Reserve. They're expecting rates to continue to rise this year. They're expecting a terminal rate to be something above 5.1%, and then rates starting in 2024 to start to reduce. There's a huge difference between what the Fed is telling us and what the market believes. The green line represents market expectations. Market expectations would suggest the Fed will finish sometime this year and actually start to reduce rates by second half of this year. And that's a big concern. Who's right? The market is expecting the Fed to flinch. The Fed is saying they're not going to. The problem I see is that for the last 20 plus years, the investment community has been banking on this phenomenon called the Fed put. Started with Alan Greenspan 20 plus years ago. Whenever the market got into trouble, whenever the pain tolerance got to a certain level, the Fed would step in, reduce rates, and then we were back off to the races. And that's been inground into a lot of investment theories. And I think the market is expecting that to be the case again. I think it's a dangerous game that the Fed and the market is playing, because at stake is also Fed credibility. So we will see. We believe the Fed at their word. They're going to keep rates high. They're going to continue to raise rates. And then at some point, pause. Pause does not mean a reversal. And they may very well stay paused for a good deal of time. The only thing that would cause them to reverse is if we had a huge dislocation in the market, huge spike in unemployment, which is another one of the issues that they're responsible for. But in lieu of that, more than likely higher rates for the near term. If we were to try to glean something positive from this report, there are a few things. One is valuations have certainly come down somewhat. This chart looks at a number of different asset categories. You'll see those in the columns presented in front of you. And it will also talk about different metrics of valuation. So for example, yield to worse or forward PE. And you'll see either a I guess it's a diamond, green colored, or a dark circle. Let's talk about the diamond first. That's where we found things as of the end of 2021. And you'll see to a large degree, every valuation point, every valuation metric, if we look at the green diamond, those valuations were higher. They were a greater number against the scale. That scale is a z-score, which basically measures degrees of standard deviation. The dot would represent where we are currently. So if we wanted to come up with a positive takeaway, it's that generally across the board with many asset categories, as you start looking at those asset categories through the filter or lens of a certain valuation metric, they tend to look cheaper today, which means there's probably greater value. Buying now longer term probably makes some degree of sense. The issue is timing. Do valuations become cheaper still? One thing that I look at is PE ratio. And the PE ratio today is still high. The PE ratio today, especially because of the run-up we've had in the first several trading days of this new year, the PE is something like 18 and a quarter, 18.3. That's really high, especially when there's some uncertainty about corporate earnings, P over E. That PE at 18 can become quite expensive. At the high, December of 2021, as we were entering into last year, the PE got to 21. 21 was arguably 2+ standard deviations higher than norm. And some folks thought it was sustainable or reasonable because interest rates were 0 and inflation was nil. It is not reasonable or sustainable today with much higher interest rates and higher inflation. In fact, one would argue that 18 probably is not a super cheap PE either. So we need to kind of watch these numbers, but they're generally becoming cheaper across the board. And another positive is generally this year for a balanced account. Last year was difficult. Last year we had a negative equity market as well as a negative fixed income market. Fixed income is represented by the dark gray portion of each one of the upward or downward trending lines, and the equity return is represented in green. And you'll notice in those rare instances where a balanced account is down for the year, in many cases, fixed income or bonds were up for that very same year. And in extremely rare cases, when the bond component is down, is the bond component down the following year? So we think this year may very well be a good year for fixed income. In spite of what the market does or where it bottoms out at some point, long duration bonds will start to look very attractive again. And we're looking at that. Our only concern is we don't want to step too far into bonds, much ahead of the whole budget, government running out of money, hitting the debt ceiling. Once we're kind of through that, bonds are more than likely going to be an attractive buy, and certainly would be now for a longer term investor. Let's talk about what this means, kind of investing across kind of multiple classes. And generally, across all classes of investment, they all tend to do reasonably well after consumer confidence bottoms out. This chart is a little bit difficult. It's all over the place, but that dark line that you see meandering around is consumer confidence. And you'll notice in areas in the past where consumer confidence peaked, where the number rests well above the horizon or the blue hash mark, you'll see a number typically that's either slightly positive or slightly negative in most cases. And that represents the 12-month forward return on the broad-based market. And you'll notice where those hash marks bottom out when consumer confidence is drained and at its worst point, the following 12 months, the returns generally are quite substantial. In fact, looking at 8 peaks and 8 troughs, when the market peaks, the average return on the S&P over the course of the next 12 months is about 4.1%. And in the average of those troughs, it's nearly 25. Now, the issue is, has consumer confidence bottomed yet? I feel a whole lot more comfortable about where consumer confidence is if we had a better understanding of where employment goes. Employment has been relatively strong. Consumers continue to spend. Although the average savings rate has been dropping steadily, the average balance on credit cards has been increasing. Additionally, many economists are suggesting that a lot of the free government money that was passed out in 2020 and early 2021 will come to an end, meaning those balances that are residing in bank accounts will be spent by late this quarter or very early second quarter. So we'll see how those issues affect consumer confidence. We're watching this very closely. As I said before, in terms of adjusting portfolios, managing clients' dollars, we've got to get 2 things right. Where are we in terms of the economic cycle, and where's the Fed? Obviously, the argument would be the Fed is certainly a lot tighter today than a year or so ago, where they were extremely loose and accommodated, and had been for quite some time. And while we might not be in a recession now, we most certainly are going to be entering into a tighter environment. It's important to know because that has a lot to do with our positioning. I'd like to share with you this slide, which is brought to us by a company called ClearBridge, which gives us an idea of economic activity. Those 12 key economic components are graded, and the result is a color. Green would indicate expansion or improving the economy. Yellow would generally be a rate of change issue, a decrease in rate. And then red would be something that is hurting or contracting the economy. And you can see through December 1st or 31st, many were red. Some of the greens as of August had turned yellow. Some of the yellows as of August also turned red. And yet there are 2 areas, housing permits, which at some point may continue to show some weakness, and job sentiment, which may in fact roll over as claims increase. So there's still some degree of weakness ahead. If we look at portfolios, especially large IRAs that we manage typically in what we refer to as a dynamic global balanced fund, those accounts today are quite conservative, quite defensively structured. And this defense has been something that has been progressing since really the fall of 2021. Back in 2021, if you look at the far right, September of 2021, everything was green. It was a risk on opportunity. If there was a time to shade the portfolios, be a bit more aggressive, it was certainly any time leading up to that point. And then since then, there's been a slow and steady degrade of those numbers. And then starting in March of last year, the Fed started raising rates. And then we quickly saw a quickening in terms of the level of degrade. This is important because the market tends to lead the economy, as this chart will show. The blue S-curve represents the economy, full recession, early recovery, full recovery, and such. And the red S-curve represents the market bottom, bear market, market top, bull market, etc. And you'll notice that the market bottoms and starts to recover, this is far left, before or while the recession is still getting worse. And the recession finally bottoms out after the market has already started some degree of recovery. We're not even in a recession yet. If we were to look at timing, maybe first third of the year, we see the market bottoming out, and then we see the recession bottoming out late 2023, early 24, or at least that's what the timing would look like at this point. Well, I appreciate you listening. As always, if you know anyone, friend, colleague, family member who might like a second opinion, by all means, reach out. You can simply call us, go to our website and click Get Started. We would love to have that conversation. And we will take them through our evolutionary wealth process. As always, if you have any questions, please call us or visit our website. Once again, thank you for your time and consideration. Happy New Year, everyone. Talk to you again real soon. Take care.